Hey, this is Sasha, and thanks for joining me here for another session on trading and investing. Now today what I'd like to do is share with you some insights on high-paying dividend stocks that pay you over 20%. And I also want to share the risks that go along with that. Now first off, if you don't know what dividends are, it's basically a sum of money paid periodically, usually quarterly, to its shareholders from its profits. In simple terms, if you have the stock, if you own shares of a company that's a dividend-paying company, basically not every company has dividends, but if you have shares of a certain stock that pays dividends, you get a check, well, not a check, but you get a sum of money that's paid to you in the form of dividends, basically cash, into your trading account. So every 3 months, they pay you money for simply holding on to those shares and not getting in and out of them all the time. So that's what dividends are. Now you get paid based on the number of shares you own. In other words, the more shares that you have, the more money you get. And that's the way that they make it fair. So for example, if you have 10 shares, you're going to get much more than if you had 3 shares of the company. If you had 5,000 shares, you're going to make a lot more money than if you had just 1,000 shares, simply because they pay you on a per share basis, because you're contributing much more to the ownership of their stock. And this is how some people really make a fortune in the stock market, is if you have a lot of money, let's say $10 million, and you have some really good dividend paying stocks, then you can make a fairly decent living simply from the dividends. Now there are some issues, of course, that go along with this, is because people get attracted to high paying dividend stocks. But remember, in the market, you're making money from 2 different ways, at least from dividend investments. Right? You're making money from, number one, the dividend itself, right? The payout. So if I paid you $1 for every share, if you had 1 share, you make $1. If you had 2 shares and I was paying out $1 for every share, you get $2. 3 shares, $3, and so on and so forth. So that's the first way. But the second way is also through appreciation, right? As that stock heads upward or it goes to the upside, you also make money. But if the stock goes down, then, well, you lose your account value. And keep in mind, you know, some stocks, they can shed 30, 50%. And in order for you to make those dividends, to make it back in dividends from that depreciation, it actually would take quite a bit of time. So keep that in mind, is that you're looking for appreciation and also a nice dividend payout rate. Now, for many people, they get sucked into these high-paying dividend stocks where they're very speculative and very risky. And that's exactly what I want to cover today. So I don't want you to fall into these traps. In general, big picture concept. If you're investing in dividends, look for the popular companies, the stable companies that have been paying out consistently time and time again, like a Walmart, a Procter & Gamble, looking at like a Deere or Verizon or an AT&T. Those kinds of companies, they've been paying out time and time again. But here, I want to share with you some more speculative plays where they still pay out a dividend, but you should probably be aware of them, and most people should stay away from them. And these are just basically the things to watch out for. And I'll share with you some examples so that way you can see where the issue is and the aha moment. So the first company I want to mention to you is TOO. Now, you can see that this one, TOO, the dividend payout or the yield here is 26.35%. And this is where people get a little bit excited. They're like, whoa, 26.35%, that's fantastic. And that is because, well, the share price, and you can't see it right this second. If I zoom a little bit here, you can see the share price is $1.67. And if they're paying out, you know, 11 cents, because this is 44 cents every year, so 11 cents per quarter, it's quite a big percentage or rate relative to its share price. So if I look up this company, TOO, and we go back, you can see it used to be a fairly popular company at around $34 a share. And now what's been happening, as you can see, stock price went up a little bit between 2009, 2014, and then just started to tumble on its way to the, you know, to the gutter. So over the last few years, it just continues lower and lower. And if you start looking at the weekly, you can see it's just so tough to get beyond that $10 range for this stock. If you go into the 2-day, it just continues to sink. So this one is pretty much toast. So for you, if you're looking to invest in this one, you know, why would you want to put your money in here because of the dividend. Maybe that dividend is going to go away, may not be around. And that's the issue. Some people that are, got in this one right here lost quite a bit of their account value, right? It used to be around $12, $13 at this price point. Now it's $1. So you're losing like 80, 90% of your account value. Now, yes, you're getting 11 cents for every share, but that doesn't make up the difference for that 90% loss. So that's the thing, is when you're looking at this 26%, it sounds pretty good, but really, if you take a look and you look at the payout, it used to be better, right? But the payout isn't stable. So here you had 52 cents in 2013. Then they went to 45 cents and 53 cents. Then you had 11 cents from then on. And eventually that dividend will probably go away if the share price drops too low, because they won't have the capital to keep paying the dividends. So that's the thing about these companies, is you want to be a little more careful, because yeah, they are a little bit attractive since you have a high percentage, 26% in this case. But remember, depreciation matters quite a bit as well. So here's the other one, BPT, okay? Never even heard of this one, but it's a $19 company right here, okay? So it's a $19 company. The dividend yield, you're also looking right around 22%, 4.39, okay? But the growth doesn't really show too much about the growth. Let's look at it on the chart, BPT, right there. So if you look at this one, whoa, look at that name, right? So you had a little bit here, a little bit of a kind of a growth stage, nice acceleration, and then after that, that stock from the 115 range just continued to tumble, and now it's in this gutter. So again, it makes it very tough. Once they've been these popular companies at these high ends and sell off in a big way, it makes it very tough to get out of those ranges. So again, if you look at this one on the dividend basis, BPT, and I go ahead and do a quick little research, you can see right here, it used to be $2 a share for the dividend, then $3, then $1.42, then 60 cents. Now it's back to $1. So you can see the dividend is not stable, and you don't know when they're going to stop paying the dividend. You don't know when they're going to reduce it, increase it. It makes it very tough, because remember, it comes down to how much money they have on that balance sheet. And if they don't have the capital to pay you, you may not get paid, right? So anyways, long story short, be careful with these high percentage yields, because they do sound attractive, but in retrospect, it's actually quite risky. Here's another one, SDT. So if we look at this one, okay, this one, if you look at the share price right here, and we look at it, it's $1.31, right? So there's your $1.31, and the dividend yield right there is 21.28%. You're basically getting 28 cents a year. And that is because the stock is cheap. SDT, if you look at it, this stock is toast, right? So if you look at it for the last few years, it can't even get out. And if you're dreaming and hoping that this thing eventually gets out, it's kind of a little more delusional, because you're hoping and wishing, because most people are getting into the more popular companies. There's a lot of popular companies. I'd rather get into the Mattel stock, even though that one's not even doing so well, than that one. At least it's kind of been holding up. But then you also have AT&T, or you have a Verizon. It's a little more expensive, but comparing it here, this stock, more than likely, you're not going to get anything as far as appreciation goes. Okay, the next one, let's just go to the chart first, is VOC. So you can see this is the Energy Trust. You can see this has kind of had A to B, B to C, C to D pattern. And now it's kind of been under that $6, $7 range for quite a while. It's $4.19 right now. If you look at this one on the dividend payout, VOC, there's the Energy Trust, and you're looking at it. Here's a dividend of 20%. 20% sounds phenomenal, but unfortunately, it's only 84 cents every single year. So again, here, let's take a quick look. VOC on the dividend payout, $4.19. So you can see 41 cents, 53 cents, 11 cents, 5 cents on the dividend. Look at that. It's completely cheap. 9 cents, 10 cents. So, it's still a big company, right? And in retrospect, any company that's listed on the stock market is quite big. But compared to other vehicles where you could put your money on there, this company is not one that I personally would want to go for because of the, again, stock appreciation doesn't seem to be there, and the dividend is also weak. So combining it with those two factors, there's better places to put your money. Again, everything is competing for your money. And in this case, that one is not doing such a great job. SDR, Sandridge Mississippian Trust. Here again, 6 cents, 6 cents, 5 cents, 29 cents, 42 cents, 62 cents. So here again, SDR, you can see this stock, $1.39, continues to go lower. And if you look at it right here, SDR, here it is, pulling it up, 19%. So not quite a full 20% on this, but you have a 19% dividend right there. So 28 cents every single year. And finally, the last one I want to mention is MSB. Okay, so again, these are just high percentage dividend yields. It's not a full 20%. You got a 16, 17% range right here, $2.20 on the payout. And when you look at this one here, MSB, and you look at the dividend payout, you're looking at 46 cents, 88 cents, 64 cents, 20 cents, 10 cents, 55 cents. So again, it fluctuates. It's not very stable. If you look at it on the chart, I'm looking for appreciation. This one has had some trouble. Now, fortunately, the good news for this stock right here is it did have a slight little bounce because of these levels right there around the $5 range. So far, that's been pretty stable. But what can happen? Well, this stock is bouncing right now, and then eventually it can try the $5 range again, bounce a little more, and then break the $5 range. So, sometimes these things, what they may actually end up doing is it's just prolonging the inevitable. Now, may not happen with this company, but again, you might get a bounce, come back here, do another little bounce, and then isolate like this for a little bit, and then finally break that range and kind of get in there and be like one of these other companies like this SDT and so forth, and just continue to get smaller and smaller and trade on a micro level. So anyways, those are some insights on some high-paying dividend stocks. So I hope by now you can see that high-paying dividend stocks or a high-paying percentage rate is not necessarily the only thing that you want. Because you can see that the stocks, many of them, the more that they pay out on a percentage basis, the more likely that they'll continue to depreciate. And that is because they're compensating for the appreciation factor that's going on underneath the surface. Companies like an Apple, they actually underpay their dividend. Some companies don't even pay a dividend because they believe that the stock appreciation is what investors want. So if you're looking for a dividend play, if you're looking for a stability, you want some companies that are also stable, that are paying out consistent amount, where also the dividend continues to grow in the future. It continues to increase with time rather than, fluctuating or even decreasing with time. And of course, you want that share price to also increase. So you're making money from those two ends as far as a basic dividend is concerned and as far as stock appreciation goes. Now, of course, you could tie in some options and sell some upside calls that go along with it. And now you're looking at doing or creating an income from 3 different ways in the stock market, but that's getting a little more complicated. But I hope by now you see and understand that the reality is that nobody gives you anything in the market. The more that they pay out on a percentage basis for dividends, the more that they have to compensate for their share price or the potential depreciation in that stock. So thanks for joining me in this week's video. I hope you found it helpful and insightful. Now, if you want to get some more in-depth training, take a look at my website and see some of the books that I've written over the last few years, or look at some of the video courses that are really in-depth about technical analysis to options and much more. Now, if you'd like to join me on a live webinar session, which is kind of like a little bit of a group coaching or group consultation session, where you can ask me some questions and I'll give you my answers and my thinking behind it, or take a look at the current market and the market conditions and some stocks, then by all means, join me on my newsletter by clicking this button right here. When you get there, enter your name and email address and you'll be added to the newsletter list. Once you're on the newsletter list, you'll be sent those newsletters periodically with announcements. You'll also get some insights to those live classes where you can register absolutely free, and that way we can have our session. Thanks again for joining me, and in the end, remember, do what you love, contribute to other people, but most importantly, live life abundantly. I'll see you next time.